Most people saw the headline, but very few understand why this single U.S. decision could affect economies around the world. This decision comes at a time when the global economy is already under pressure. Inflation remains high in many countries. Economic growth is slowing, and governments around the world are dealing with rising debt. Over the past 2 years, central banks globally have been closely watching the United States. That's because when the U.S. changes its economic policy, the impact rarely stays inside America. And this latest decision is no exception. This week, the U.S. Federal Reserve announced that it would keep interest rates unchanged. After months of aggressive rate hikes aimed at controlling inflation, the Fed has decided to pause. On the surface, this may seem like a routine policy update, but in reality, it sends a powerful signal about how the U.S. views the current state of the economy and what may come next. Interest rates affect nearly every part of daily life. When rates are high, loans become more expensive, businesses delay investments, consumers reduce spending, economic growth slows down. By holding rates steady, the Federal Reserve is signaling that inflation may be cooling. But the economy remains fragile. For Americans, this means borrowing costs are still high, and relief may not come quickly. But the impact doesn't stop at the U.S. border. The U.S. dollar is the world's most influential currency. When U.S. interest rates remain high, global investors move money into American assets. This strengthens the dollar and creates pressure for other countries. Nations that rely on U.S. dollars to pay for imports like oil, food, and technology feel the effects immediately. Emerging economies are often hit the hardest. Even small changes in U.S. monetary policy can raise costs, weaken local currencies, and slow economic growth across the globe. That's why markets in Europe, Asia, and beyond reacted within hours of the announcement. However, this decision also carries risks. If inflation rises again, the Federal Reserve may be forced to tighten policy further. That could increase financial stress, weaken vulnerable economies, and raise the risk of a global slowdown. This uncertainty is why investors remain cautious, even after the Fed's decision to pause. In the coming weeks, attention will turn to key data. Inflation numbers, job reports, and consumer spending will help determine whether this pause is temporary or the beginning of a larger shift. So this wasn't just an economic update, it was a signal, not only about the future of the U.S. economy, but about the direction of the global financial system. And the full consequences of this decision are only beginning to unfold.